Whenever people talk about investing, the conversation almost always goes to the exact same place: what to buy. Right? Should you be in this stock or that ETF? Is this market about to pop or is that one? But what if I told you that focusing on what you invest in is like obsessing over the brand of fancy gasoline you're putting into a car that doesn't even have an engine? Yeah, so let's get into it because the real, actual drivers of long-term success are these three forces that honestly, most people just ignore completely.
So what is the real secret here? I promise you, it's not about having some genius-level IQ or finding a secret strategy that nobody else knows about. The answer is actually way, way simpler and honestly a lot more powerful. It's all about understanding the fundamental forces that are really at play. And here it is, side by side. On the left, you've got all the stuff people get obsessed with, the latest stock tips, trying to predict the market, looking for that secret formula. But on the right, that's what actually moves the needle over the long haul: time, your own behavior, and just plain old consistency. We're going to forget all the noise on the left, because these three things on the right, they are the absolute foundation of everything.
All right, let's kick things off with our first force, and you could argue it's the most powerful one in the entire investing universe: time. I want you to think of time as the actual engine in your investment vehicle. Seriously, without it, you are just not going anywhere.
So what's the magic that makes this engine run? Well, it's a concept you've probably heard of before: compound interest. The best way to picture it is like a tiny snowball at the top of a really, really long hill. At first, it's barely growing as it rolls. It feels slow. But the longer it rolls, the bigger it gets, and the faster it starts picking up more and more snow. Your money does the exact same thing, where your earnings start making their own earning.
And check this out. This table visualizes that snowball effect perfectly. Just look at that 10% column. In the first 10 years, your $1,000 grows by about $1,500. Not bad. But look at the last 10 years, between year 20 and 30. It grows by over $10,000. See? The biggest, most explosive gains are always stacked at the very end. Time really does reward patience, not speed.
This chart just drives the point home. It shows why starting early is so much more important than trying to start perfectly. By waiting just 10 years, going from 25 to 35, you could literally slash your potential retirement nest egg in half. That is the raw power of the engine of time. The person who started earlier just let time do all the heavy lifting for them.
Okay, on to our second force, and this one builds right on top of the first. If time is the engine of your car, then your behavior, well, that's the steering wheel. It's what determines whether you actually reach your destination or, drive straight into a ditch. Just take a look at these numbers from 2021. The market itself, the S&P 500, had an amazing year, up almost 29%. But the average investor, they only captured a fraction of that, just over 18%. That is a huge gap in performance. So what happened? The investments didn't fail, the investors did.
And that gap? It's caused by a bunch of totally predictable, totally human behaviors. We get scared when the market drops, so we sell at the bottom. We get greedy when something's hot, so we buy at the top. We let scary news headlines completely derail our strategy. These emotional reactions are, without a doubt, the single most destructive force in most people's portfolio.
And hey, if you think you're the one who can outsmart everybody by jumping in and out at just the right time, this data from Dalbar is, well, it's pretty humbling. It shows how often investors actually guess right about which way the market is headed. The answer? Less than a third of the time. It's just proof that trying to time the market is a game you're almost guaranteed to lose.
The legendary investor Charlie Munger just nailed it with this quote. He said, "The big money is not in the buying and selling, but in the waiting." Real wealth isn't created by a flurry of activity. It's created by having the discipline to do the one thing that's hardest for us humans: just wait. That's the behavior that wins.
Okay, so we've got the engine of time, and we've got the steering wheel of behavior. But how do you actually connect the two? Well, that brings us to our third and final force: consistency. This is the bridge that truly activates the power of time and keeps your behavior pointing in the right direction.
So what does consistency actually look like? It's almost shockingly simple. It just means investing on a regular schedule, every single month, every single paycheck, no matter what the market is doing. It means you make a plan and then you actually stick to it. And maybe most importantly, it means you resist that constant urge to mess with it every time you hear a new expert opinion. So many of us wait for that perfect moment to invest, right? We're hoping to make one big, heroic, brilliant move. But wealth isn't built that way. It's built on small, boring, endlessly repeated actions. Those consistent, automatic contributions take the whole risk of bad timing off the table, and they turn investing into nothing more than a simple habit.
And you know, the real beauty of consistency is that it frees you from all that anxiety of trying to make the perfect call. That question, is now a good time to invest? It just becomes irrelevant. The answer is always yes, because it's just what you do on schedule. This kind of systematic approach protects you from your own worst enemy, your emotion.
So now we have our three forces: time, behavior, and consistency. And here's the crucial part. It's how they lock together. These aren't just three separate ideas. They are all part of a single, incredibly powerful system for building wealth.
This right here, this simple equation is the real formula. See, true compounding isn't just about the math. It's the end result of good behavior, the right steering, and consistency, which is the bridge, all applied over a very long period of time. That's how you unlock its incredible power.
Let's break it down one more time with our car analogy. Time is the engine, right? It creates the potential for growth. Consistency is the fuel you add on a regular basis to keep that engine running. And good behavior? That's what keeps you on the road and stops you from crashing. Take away any one of those pieces, and the whole system just breaks down.
You know, the author Morgan Housel put it so well. He said financial success is a soft skill. Your success has so much less to do with how complicated your spreadsheet is, and so much more to do with your temperament, your patience, and your discipline. Basically, how you handle fear and greed matters way more than what you technically know.
And all of this leads to a really counterintuitive truth. Once you have a solid plan in place and you're fueling it with consistency, the single most valuable action you can take is often no action at all. Resisting that deep-seated urge to react, to do something, that is an absolute superpower in investing. So let me leave you with this. If your investment journey feels a little, well, boring, congratulations. Seriously. That's not a sign you're doing something wrong, it's a sign of discipline. In investing, excitement is usually just another word for expensive. Boredom means you're not reacting to the noise, you're not chasing fads, and you're letting these three forces do their quiet, powerful work for you. Which brings us to our final question, and this is what I really want you to think about. Look at your own approach. Is it designed for excitement, for the adrenaline rush of the next hot tip, or is it designed for results, calmly executing a plan that will get you where you actually want to go? Because in the end, you can have excitement or you can have results. It's just very, very rare that you get both.